Well, happy Friday, everybody. Colin Harper, joined as always by Michael Kutch. Mike, how's it going this Friday?
That's going pretty well.
Awesome. So we got a good show in store for you today. I am at my home office here as my car's brakes went out yesterday. Not while I was driving, thankfully, but I am stuck at home enjoying the chaos of the little ones stomping around upstairs and getting some work done in the basement.
Yeah, you want to have those breaks. And it looks
Oh,
like I'm clean shaven today on this Friday, and you're getting the mustache coming in strong.
well, I can't have a beard anymore, so we've opted for the mustache, and we're gonna see how long we can take this bad boy. So looking forward to that. So hopefully it grows alongside the market for the rest of the year. But just a quick disclosure: nothing we say here is specific advice to your situation. Always consult a trusted financial professional in any specific questions you may have. We get together every Friday, talk about our thoughts on the market, and then we do a bit of a planning topic. Our planning topic today is how much does inflation actually affect your retirement picture and what that looks like. And I've got a calculator I'll pull up a little bit later after we touch on what the market looks like so we can talk about how much of an impact inflation really does have. And I would say, depending on how many years you have before retirement, inflation can have a very, very large impact on retirement. So it's important that I think when things get uncertain, long-term investors have a tendency to want to pull back from a long-term focus and focus on the short term. But with inflation in play, that's one of the biggest reasons that we need to be invested long term. So that's the scope. We'll look at that discussion a bit later. But Mike, one of the big things over the past week is the debt downgrade. We haven't seen this since 2011. We have some data from that and what that looked like. But is this something that we should be really concerned about? Is it just another bump in the road of a very, very pothole filled market that we've kind of been navigating this last year or so? Or what are your thoughts on the debt downgrade?
I think it's more of a warning to the government that, we see where your debt level is and we're aware of it. It's getting to uncomfortable levels. They issued that warning around the debt ceiling. And I mean, that the debt ceiling resolution is not really resolved. It was just kicked down the road a little bit. So I think that comes back up in probably September or October.
Yeah.
But the market, I mean, it was down the day after it happened. This time around, by the Nasdaq was down close to 2%, S&P 1%, Dow a little less than that. Like it had some volatility, especially compared to the last 5 months where we haven't really seen those 1 day plus or minus drawdowns. But I think market participants really remember what happened in 2011. Yeah, there was a big drawdown. I think S&P probably dropped around 17%, but then it recovered very quickly. By the end of the year, it was back to the same level. So I think it was kind of shrugged off. And overall, it's U.S. government debt. They're not really concerned about. You're not buying it for fear of it. Like default doesn't really come into play when you're buying a treasury in the U.S.
We'll be on the barter system if the U.S. government defaults. So
we'll have bigger problems.
We'll have much, much larger problems if that happens. And it's like, we always talk in planning. We can only worry about the things we can control, right? I think most of the country feels like our spending as a government has been outrageous. What other entity can go around and just keep assuming more and more and more debt, right? The government's the only one.
Yeah. And now that interest rates are so high, the debt servicing is much higher. What we're actually paying in interest a year, it's getting to a point of ridiculousness.
Oh, I mean, it started at a point of ridiculousness a long time ago, and now it's just almost unbelievable what's going on there. But like you said, it's amazing. In 2011, the market shrugged it off. It looks like the market's going to continue to shrug it off here.
So, yeah, and I think in 2011, I think the 1 day after move was something like 5 or 6%. So like there was a huge reaction on that first day. Yeah. But it was unfamiliar territory. Now we kind of know what happens, and it's not the end of the world, at least.
Now we've just accepted our poor choices in general and move on. So so definitely wanted to bring that up. What other data came in over the week that you were kind of looking at? It's amazing that we're actually getting a lot of positive signs when we were talking before we started this call.
Yeah, it's been a weekly basis where you're getting better news on the growth prospects and lower than expectation on different inflation prints. So the big highlight of the week was the employment report that came out this morning, and it was kind of had something in for both the bulls and the bears, the soft landing and the hard landing. The headline number came in below expectation, below 200,000 for the first time since, well, I think it was at 187, which was the lowest reading since December of 2020. And then you
Mhm.
also had a revision down to the prior 2 months. So actually, last month, the adjusted amount was down to 185. So you're seeing some deceleration in job growth, but at the same time, our average hourly earnings are hanging in there on a monthly basis, coming in at 4/10, slightly higher than consensus, but marginally lower than last month. On a year-over-year basis, that's 4.4%, which was 2/10 higher than consensus, but in line with last month. That still needs to come down more. The Fed would like to see that between 3 and 3.5% to be in line with their 2% inflation target. And then you had unemployment rate tick down to 3.5%. You did see some weakness in average hourly work week. Um, and then at the same time, participation rate was in line. So nothing too astonishing. It kind of paints a picture of a potential soft landing, more of a moderation in the economy. And then you got some other good data. Yesterday, I think we got the unit labor cost for quarter 2 came in below expectations. So the Fed likes to see that kind of thing because of what it means for wages. And then at the same time, you saw a big beat out of productivity for the quarter. So that really feeds into GDP. So that's a good sign. Besides that, we got some ISM data. Services and manufacturing came in a little light, more so on the services. But overall, manufacturing was a slight uptick, I believe, from last month, whereas ISM services, it's still an expansionary territory, but just like the jobs report, is moderating. So all good signs at this point, and the stock market's still in its uptrend. We're probably close to 2% off of the highs at the end of July. Nothing too major. The trend's still intact. I think we're just digesting these earnings, which have been pretty mixed. Overall, the beats have been pretty good above the 5-year average, but revenue beats are lower than expected, and stock reactions have been kind of a mixed bag. I would say more companies are probably delivering, even on good news. Sometimes they're selling off just because of like valuations got stretched. A lot of stocks are having really good year-to-date runs. So same thing like last night. You had mixed. Amazon was really good, very strong quarter. Apple was a little weak. Guidance was a little weak. So you're kind of seeing different areas in different segments of the stock market. But overall, it looks pretty healthy. I think we are a little stretched still. If you look at where we're trading compared to those key moving averages, there is a big gap in that. Typically, that mean reverts to some extent. So we could see some consolidation in the coming months. Seasonality wise, August and September are two of the weaker months. So we got to get through that period and get into the fall.
Well, time will tell, and it is encouraging to see a lot of positive things happening on the macro side of it. I think
I
that'll.
I was getting slightly concerned about where interest rates were heading. They were pushing the all-time highs. The 10-year got to close to 420, but the move today is a lot more reassuring. I think the 10-year is down 10 basis points. So as long as we stay below those
Yeah.
tops, it's good news still. But the trend's been higher there.
Yeah, absolutely. And so I mean those heightened interest rates and rising inflation kind of tie in perfectly to our planning topic for the day. How much does inflation actually affect your retirement income needs and your retirement picture? And I'll pop a slide up here. It's a calculator we have on our website here in a second. But I think one of the biggest things to remember is that this period we've been in is fairly abnormal in, just how much inflation we've experienced in a very short period of time. So when we look at inflation, we project it out, we really like to work more on annual averages. And the annual average of inflation is a little over, 2% historically. Obviously much, much higher the last, year or so. And that's, one of the reasons the Fed's been so aggressive trying to
And
get it in
actually, I
check.
think I think the period in the last 15 years was closer to that 2% or even slightly below
Oh,
it. But
yeah,
the longer
absolutely.
term 40 or 50 average is probably closer to 3%.
Yeah. Yeah. So I mean, so our before we were in this inflationary period, we actually had very low inflation for a long period of time leading up to this. Um, so whenever we're working with financial planning, right, it's important to take a long focus. Don't worry so much about year over year, but look at 5, 10, 15, 20 year segments. And so I think we can agree that in long term inflation is on a high estimate around 3%, low estimate around that 2%, right, Mike?
Yeah,
Okay.
and honestly, I think we're more likely to get back down to the 2% range over time, just because of all the advancements in technology that lead to an increase in productivity.
Definitely. So if I pop up this here, right? So how much does inflation actually affect your retirement? So this is a very simple illustration. This assumes that we have a 55-year-old who wants to retire in 20 years at age 65. Current annual income is 100,000. And I'll pop over to this screen so I can actually scroll down.
You want to stay closer to the mic. You're kind of going in and
Oh,
out.
yes, yes.
Beautiful.
Beautiful. So if we look at it, we look at our 55-year-old who's making 100,000 a year. We just use round numbers. We are assuming an anticipated inflation rate of about 3%. So on the higher end of that estimate we were talking about, Mike, we're planning for them to retire at 65, life expectancy out to 95, and we're going to replace about 75% of their income. This is just a real standard thing. Sometimes we're replacing less income, sometimes we're replacing more whenever we're doing that. But if we go into the calculate here, whoops, um, in if $75,000 is today's number we need for retirement, you may be surprised that in 20 years, that $75,000 to replace that same purchasing power at 3% inflation annualized, we're going to need about $100,000 a year when we start retirement at age 65. If we take that out to age 95, we're actually going to need $244,000 of income every year to replace that $75,000 in today's dollars. That's way out. That's at age 95. But I think that does a pretty good job putting it into perspective. And when we talk about inflation, if you don't have investment vehicles that are capable of keeping pace with inflation, you're going to be way behind the eight ball. And that's why a lot of our longer term investors are focused in the stock market and other assets that are able to grow at a rate like that. But you really shoot yourself in the foot if you go a bit too conservative in your investment planning, especially when you have a long time horizon. And that long time horizon is one of those things that gives us a lot of flexibility in what we're able to invest in, because the longer the time horizon, the more capacity someone has to take risk. And that's just due to the sequence of returns of the market. So, historically, if we look at 10-year rolling periods, we're going to do much better than if we look at 1-year rolling periods, for example. The market can be, up 20, down 30. And when I talk about the market, I'm just talking about the S&P 500, just your basic U.S. stock index. But one of the things that's important to reminder is make sure your plan takes into account inflation. The software you use builds it into all our planning, right? We, automatically adjust for inflation every year in our plans and have those costs increase. Things are more expensive. I mean, especially now. I mean, just look at how much simple things like eggs, bread has gone up here in this, inflationary period. And that's, very typical. There's nothing shocking about that. Some of our older listeners, I would love to hear, what did a loaf of bread cost when you were growing up? I mean, I'm sure it's a fraction of what it costs today, but that's the way inflation works. That's just, a thing we need to be cognizant of and make sure it's built into your plan. But a lot of people don't look at it in dollars, in today's dollars, future dollars, things like that. So I just wanted to highlight this as free tool anybody can check out. If you're curious, you can put your own numbers in here and see what it kicks back. But make sure you're building in inflation into your planning. It's a crucial part of the picture. And if you haven't thought about it or talked about it, right, it's a very important topic you'd want to address with, your financial professional. So that's my 2 cents, Mike. That's all I got today. little calculator, little show and tell, a little something different,
That's pretty fancy.
little something different today. But I hope you all have a fantastic weekend. Enjoy the beautiful weather. I know it's beautiful up here, Mike. I hope it's nice in the sunshine.
We have pretty nice weather, but if the trend of the last 2 weeks is gonna show any continuation pattern, we'll have rain at some point today.
I don't doubt that. I don't doubt that one bit at all. But everybody stay safe, stay healthy, and we can't wait to catch up with you next week. Thanks.